Joining us now to share his commentary on the day's market performance is Aheesh Singh from MP9 Asset Management. Aheesh, thanks so much for your time this afternoon. And I guess let's start off with general markets action, right? Trade has been choppy for most parts of the week. There's also been a tech sell-off. We saw the Nasdaq taking a knock in yesterday's session. What's been fueling that, Aheesh? Is it something to be concerned about, or is it just some, profit taking ensuing on that front?
Hi, Antauling. Yeah, I think it's very important to be cognizant of what's happening right now, especially with Jackson Hole. I think traders are a bit jittery around that and what could come out from that. And I think you will see an increased amount of volatility until that finishes.
Okay, so with that in focus, right, we have the upcoming Jackson Hole, which starts today. We also got those Fed minutes yesterday showing that governors are still concerned about the impact of tariffs on inflation. There's also concerns around the labor market, as we saw the lost jobs market numbers cooling off. With that being said, does this suggest that perhaps we might see that rate cut coming through in September? Would you rather take a wait-and-see approach just to hear from Fed Chair Jerome Powell tomorrow before making in or pricing in those rate cut bets?
I think the market is taking a bit of a wait-and-see approach. I think there's a balance between the inflation risks as a result of tariffs, but also the weakening growth and the employment issues in the US. So I think the market will take guidance from Jackson Hole going forward.
And sticking with the US then, Aheesh, the US consumer has also been under the spotlight with those US retail earnings coming out this week. We are still awaiting numbers from Walmart, but we have seen numbers out of Target and Home Depot. Some indicators pointing to some pressure coming in with spending somewhat slowing down. Now, these financials, a cause of concern then when we talk of growth and I guess purchasing power as a whole. Is the resilience of the American shopper being tested at the moment?
So Target and Walmart have a different sort of earnings profile from what we've seen, at least, or a different earnings trajectory, with Target being quite flat over the last 2 years, as opposed to Walmart doing quite well. I mean, the Walmart share price is up 37% over the last year, if I'm not mistaken. And I think historically, traders and investors usually look to Walmart as a gauge for consumer health. So I think the upcoming results will be very important as to gauge what the consumer health in the US looks like.
And what about a retailer like Home Depot, where I guess most of the discretionary spend would then go?
Yeah, I think I would take a wait-and-see approach with that as well. Let's see how things play out, and I think we should look to the Jackson Hole to see what happens.
All right, so talking about purchasing power, just bringing it back home, consumers seem to be spending some of their money on takeouts. We are seeing this in Spur's results, posting upbeat profit and benefiting from stronger restaurant sales. It's also interesting to note that, yes, the firm is positive, but it is warning that, consumer spending power moving forward could be subdued. Just your general analysis of those numbers.
So we don't hold Spur, but I've followed it for quite a while. I think they've got a decent management team, and they've done well against the current backdrop. Strong earnings profile, good cash flow conversion, and I think they've done really well to stabilize their brand in this market.
And then over in the mining sector, then Aheesh, Exxaro delivering a 13% jump in HEP, supported by stronger export and domestic sales. Markets really liking the numbers. I think the last time I checked, that share price up 11%. Is this one you watch in particular?
Yeah, so this is something that we do hold in our portfolio. We've held it for a while. I think it's a phenomenal set of results given the backdrop in the coal market right now. And I think a company like Exxaro is beholden to the coal price. And they've done well operationally to sort of, fight against those headwinds.
So would you be a holder of, I guess, well, you are holding Exxaro.
Yeah.
So it would be a bet on Exxaro over Thungela?
I think at this time, yes.
Okay.
It's a much more mature business, yeah.
All right, let's move over to the telecoms space. Blue Label expecting a surge in earnings. No reason has been given for that surge, but I'd like to get your take on the company. It's become a market fave after it released those restructuring plans where it is hoping to potentially list Cell C. What have you made of that, and what have you been seeing when it comes to the share price movements there?
So I think Blue has done really well in turning Cell C around, but I think we need some clarity in terms of results, in terms of the cash generation, the balance sheet strength, and we'll see that with upcoming results. I think the market has sort of priced that in, but I think it's looking for ongoing sustainability of those earnings.
All right, so that share price now up 4.5%. Let's just hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on what counters your industry peers are watching closely.
I've been an investor in Richmond for a very, very long time. So this is not one of your, you need to buy this and you'll get rich, overnight type of scenario. This is one of my largest holdings. It's been a fantastic quality company, but we've just seen in recent movement in luxury goods in general. The likes of Richmond's, LVMH's, all these luxury companies been hammered, been under pressure, mostly due to the tariffs. We've seen some decrease in demand coming from China, but I mean this company is sitting with 7.4 billion euros on the balance sheet. It's such a healthy company. I think the recent retracement in the share price is giving us a great opportunity to get back in if we haven't been in, and if you've got a bit of a small position, I definitely think this justify a larger one.
I like the dollar's come under a huge amount of pressure this year. I know it was part of Trump's policies and that, but I think that's going to turn around. I think that US is going to, once they start reducing rates, it might hurt their bond market, but overall you're going to start seeing growth come up, and I think it'll start sucking investment money back into the economy. So it's a good time to switch your rands into dollars.
So, David, betting on the dollar, we did see the rand losing some steam today as we are seeing the dollar picking up. And then Skalk going with Richmond, locally listed one as well. It really seems to be one of the winners when it comes to the luxury sector. Just your analysis on Richmond as well as the dollar.
So I'm biased like Skalk. It's Richmond, something we hold in our portfolio, solid brands, good valuation, good cash generation, and a good balance sheet. And I definitely think it's a long-term compounder, even regardless of the current Chinese slump in demand, that should pick up over the long term. And with regards to David's view on the dollar, I think it's very important for investors to be diversified in a developed market economy. However, I would caveat that by saying that you would want to put that in a higher returning asset class, be it even an S&P 500 index fund over the long term. Those are my thoughts.
You touched on China there when it comes to Richmond and I guess the luxury sector as a whole, where we are seeing a bit of a slump when it comes to consumption. Aheesh, do you think that perhaps markets and traders maybe overestimated the recovery that they thought would play out in China in particular? Because you look at, the property sector still downbeat. We are still seeing the Chinese government considering even more stimulus to come through and boost the economy. There's also, that tariff battle that still hangs over that economy as well.
I think you'd have to take a long-term view on that. China is still a long-term growing economy. It is one of the bigger ones in the globe. And when we look at a company that has exposure to China or to Chinese demand, you'd have to take a longer-term view. In the short term, things will always be volatile.
Yeah. All right, let's get your stock pick then. Where are you seeing opportunity at the moment?
So being in Durban, I choose a Durban-based company, Mr. Price.
Being biased.
So I think it's down about 30% this year. It's currently trading at a trailing PE multiple of 15 times, which is slightly below its 5-year average. It's typically oscillated between a PE of 10 and 24 times over the last 5 years. Very, very stable EBITDA margins at around 14%, as well as very stable net income margins at 9%, and solid cash flow conversion, as well as a clean balance sheet. So I think if someone's looking for value, or at least where MP9 sees value, is in Mr. Price over the long term.
Let's leave it there. Aheesh, thanks so much for your time and taking us through trade at midday. Now that was Aheesh Singh from MP9 Asset Management.